You know that feeling, right? It's tax season. You're sitting there looking at your W-2, and you just see this huge chunk of your money gone, just gone. You put in the long hours, you sacrificed weekends, and for what? To realize you basically worked a quarter of the year just to pay your tax bill. It's frustrating, and honestly, it feels a little hopeless.
But then you're scrolling online and you see a headline that some billionaire's net worth shot up by billions, and they paid a tax rate lower than your own. Sometimes they paid nothing at all. And you think, how is that even possible? It's so easy to assume the system is rigged or that they're all cheating. But what if I told you it's not about cheating? It's that they're playing an entirely different game.
Yeah, see, the super rich aren't typically breaking the law. They're just using a different rule book, one that our tax system created. A rule book that rewards owning things, not earning a paycheck. And this playbook has a simple three-word name: buy, borrow, die. So let's break down exactly how this works. To really get this, you have to understand that we basically have two tax systems in one. There's one system for people who trade their time for money, workers, and then there's another system for people whose money makes money for them, investors and owners. And let's be real, the tax code heavily, heavily favors the second group. For pretty much all of us, the game goes like this. We earn money, the government takes its cut immediately, often before we even see the full amount, and then we live on whatever's left over. It's the classic W-2 trap. But the wealthy? They just sidestep that whole process. Their game is to buy assets, borrow money against those assets to live, and in doing so, they keep their wealth growing, far away from the IRS. And this quote just hits the nail on the head. The wealthy know that a salary or earned income is the highest taxed form of money there is. Trying to build real, lasting wealth just from a paycheck is like running uphill in the mud against the wind. The system is designed to take a huge piece of it every single time. So how do they actually pull this off? Well, let's get into phase one. It all begins with buy. See, the focus for the ultra-wealthy isn't on getting a bigger paycheck. It's on growing their net worth. So they use their money to buy assets that appreciate, things that are designed to go up in value over time, like stocks, real estate, or entire businesses. Now this right here, this concept of unrealized gains, is the absolute cornerstone of the whole strategy. It's so important. Here's what it means. If you buy a stock for $100 and it goes up to $1,000, you don't owe any tax on that $900 gain as long as you don't sell it. It's wealth on paper, and as long as it stays on paper, the tax man can't touch it. So let's run a quick example. Let's say you invest $100,000 in the stock market. Over a few years, it does really well and grows to be worth $1 million. That's a $900,000 profit. It's real wealth, it's there. But since you haven't sold anything, it's all an unrealized gain. So the big question is, how much tax do you owe on that growth?
That's right, zero. A big, fat nothing. The wealthy live by a very simple but powerful rule. Never sell your assets. Because the moment you sell, you create what's called a taxable event, and the government gets its piece. So instead, they just let that snowball of wealth get bigger and bigger, compounding year after year, completely tax-free.
Okay, so this brings up a pretty logical question, doesn't it? If their money is all tied up in stocks and real estate that they never sell, how on earth do they pay for their lifestyle? The houses, the private jets, or even just a cup of coffee. Well, that brings us to the second and maybe the most clever part of the strategy: borrow, right? How do you take that $1 million number on your brokerage statement and turn it into cold, hard cash you can actually spend without handing over a third of it to the government in taxes? The answer is going to completely change how you think about debt. Most of us are taught from day one that debt is bad. It's a weight, a burden, something to get out of as fast as you can. But for the wealthy, debt is a powerful tool. It's how they access their wealth tax-free. They don't sell their stock portfolio. Instead, they go to a bank and say, hey, I've got these millions in assets. Give me a loan against them. The bank is more than happy to do it at a super low interest rate. Now you're probably thinking, okay, but they still have to pay interest on the loan, right? Yes, but check out the math here. Let's say their assets are growing at an average of 8% per year, but the interest on their loan is only 3%. They are literally making money on the money they borrowed. It's called positive arbitrage. Their wealth is growing faster than their debt. And here is the real kicker. This is the magic of the whole thing. When the bank gives them that loan, that cash is not considered income by the IRS. A loan isn't income. So they can get millions of dollars in cash, spend it on whatever they want, and pay zero tax on it, all while their original assets just keep on growing. So, That brings us to the final piece of the puzzle, phase 3. It sounds a little dark, I know, but from a financial planning perspective, this is the masterstroke. This is how the strategy becomes a machine for creating generational wealth. Let's talk about the die part. When a wealthy person passes away, their heirs get the assets. And when that happens, a magical little thing in the tax code called the step-up in basis kicks in. And this is really the holy grail of tax avoidance. What it does is it effectively erases all of the capital gains that have built up over a lifetime. They just poof, disappear. Let's look at this simple example. Say your grandmother bought one share of a stock for $10 way back in the day. Now it's worth $500. Technically, that's a $490 taxable gain. But when she passes away and leaves that stock to you, the IRS essentially resets the starting line. They pretend you bought it for its current price of $500, so you can sell it immediately for $500 and pay absolutely nothing in capital gains tax. And that's how this cycle completes itself. The heirs get these massively appreciated assets, completely tax-free. They can then sell a small piece of them, again tax-free, to pay back any of those loans that were taken out. The debt gets cleared, and the family is left with a huge fortune, totally intact, ready to start the buy, borrow, die process all over again. So I know what you're probably thinking. That's cool for billionaires, but I don't have a $10 million stock portfolio to borrow against. And you're not wrong. But here's the thing. You don't have to be a billionaire to use the principles of this playbook. So instead of just getting mad at the system, let's learn from it. Let's talk about how you can apply these same core ideas to your own financial life. It all starts with changing how you think. You have to start seeing yourself less as just a worker and more as a capital allocator, someone who directs their money. You have to shift from being purely a consumer to being an investor. And this is a big one. You have to go from being afraid of all debt to understanding how to use it strategically. You stop being a tax victim and start becoming a tax strategist. The key here is to realize that not all debt is the same. There's bad debt, like credit card debt for a vacation or a car loan, which you use to buy things that lose value. That kind of debt makes you poorer. But then there's good debt, which is used to buy things that go up in value, like investment properties or a business. That kind of debt can make you richer. So what can you do right now? Well, here are some ideas. The next time you get some extra cash, instead of just automatically throwing it all at your 3% mortgage, maybe think about putting it into an investment account. That's a first step. It's about learning to see things like your home equity, not just as a safety net, but as a potential tool you can use. The goal is to build assets and think about how to make them work for you. Look, at the end of the day, the tax code is really just a big set of incentives. The government wants you to do certain things, like invest in businesses and real estate, so it gives you tax breaks for doing them. If all you do is work a regular job, you're not aligning with those incentives, so you get taxed the most. The goal isn't to beat the system, it's to work with the incentives that are already there. The craziest part about all of this is that it's not some hidden secret. These rules are public. They're written right there in the tax code for anyone to read. So you have a choice. You can keep playing the W-2 game, running that marathon with the backpack full of bricks, or you can start learning the rules to the other game. Now that you know the playbook, what game are you going to play?